Retained earnings refers to the amount of money that a company retains after it's paid out its dividends to the shareholders. So an example I used in a previous video regarding payout ratios where a company earned $1 and they gave out 50 cents to their shareholders and retained 50 cents. Well, that 50 cents that they've retained is called their retained earnings. Now, companies retain earnings for a number of reasons, and generally it's all about using those funds to further grow the company. So that might be to purchase machinery or other businesses to again grow earnings, which in turn builds the business. Other options that they do is obviously can make the balance sheet look better by reducing debt, by retaining those earnings to make the business and balance sheet stronger and be able to withstand downturns in their marketplace or the economy as a whole. And it also can be used for share buybacks, where the company elects that they may think that their share price is quite cheap at the moment, so they'll use that retained earnings to buy shares and reduce the amount of shares that are on issue, which means that the profit is spread between less shareholders. So that means that earnings can go up per share. So I think, as opposed to a term deposit, term deposits pay out all of their income each year, and that's why a $100,000 term deposit, where an investor takes all the money out to use, in 30 years' time will still be a $100,000 term deposit, where we've seen CSL with a float price at $2.30 back in '94 is now equivalent value of over $200 per share, and that's because they put so much back into the company in research and development, and they currently do have a share buyback plan underway. So reasonably complex, but I hope that helps.